Hello everyone, good morning. So, whenever someone wants to buy any stock or bond of any company, how do they know the price of the stock is good or bad? So, at that time, the fundamental and the technical analysis help the person to know about this. Therefore, today in this video, I will explain the both analysis and some market theories as well. So, let's get started. First of all, the fundamental analysis. This focuses on the real intrinsic value of the company for the long term investing. So, what is the intrinsic value? The intrinsic value is the real actual value of the company's stock. The goal here is to find the intrinsic value of the stock and compare it with the current market price. Through this, we can know that the stock price is undervalued or overvalued. For the study of the fundamental analysis, we have to look for the company's economical condition, interest rate, company's profit, debt level, and the future earnings. The core question is here, what should I buy? Or is this company financially strong to invest or not? Best use of the fundamental analysis is for the long-term investing, buying and holding strong companies. Next is the technical analysis. This focuses on the price trend, investor psychology for the short term trading. The goal here is to predict the future price movement based on the past behavior and the chart. For the study of the technical analysis, we have to look the stock price movement, trading volume, historical charts, uh, market trend, and the psychology of the investor. So the core question is here, when should I buy, or what is the stock price likely to the next. The best use of technical analysis is for the short term trading, finding the pattern for the stock price movement. The main difference between these two are fundamental says that what should I buy, while the technical say that when should I buy. Fundamental focus on the company's value and the financial, while the technical analysis focuses on the price chart and the trend. Fundamental for the long term investing and the technical for the short term trading. However, some market theories says that the fundamental analysis and the technical analysis are not that much effective. The first market theory is efficient hypothesis. Efficient market hypothesis. These theories say that stock price already reflect all available information. It suggests it is extremely difficult to consistently beat the market. Second is random walk theory. This theory states that the stock price changes are completely random. Tomorrow's stock price cannot be predicted from yesterday's movement. And the third is rational expectation. This theory assumes that the investors are rational and they make the decisions according to their knowledge and also their experience. For the efficient market hypothesis, this theory has the three forms: strong, semi strong, and the weak form. The weak form assumes that all past market information is fully reflected in the current price. With this form, technical analysis is considered little or the no value. The semi-strong form assume that the all publicly available information is fully reflected in current price. With this form, both fundamental and technical analysis have little or no value. The strong form state that all information is fully reflected in current price, including both publicly available and insider information. In other words, no single investor has information that provide an advantage over any other investor. Next is a random walk and the rational expectation. So, from the random walk theory, it says that the stock price changes are completely random, so we cannot predict the future price according to the past movement. And the rational expectation says that the the investors use their knowledge and purchase the stock according to their intelligence and also their experience. Therefore, these theories says that the technical analysis and fundamental analysis are not that much effective. However, in a reality, uh, also this theories has limitations, as market are not always perfect because of human emotions and the structural flaw. So the new information is not available to everyone at the same time. Second is the investor do not react the same way to the same information. The third reason is not everyone can make accurate forecast and correct valuation decision. And the fourth is Mars investor psychology and greed may at the time cause investor act differently. And to see some real world example, in 2008 financial crisis, many strong companies stock crashed along with the weak one because investors were fearful. In 2010 flash card crash, market dropped sharply within minute, partially due to the high frequency computer trading. Therefore, the fundamental and technical analysis are useful for making the decision. So, for the summary, the fundamental analysis studies the company's value, focuses on the long term investing. Technical analysis study the chart and trend, focuses on the price movement and timing. The efficient market hypothesis states that the market quickly reflects all available information in the current price. Random walk theories assume that the price movement randomly and unpredictable. Rationally, expectations assume that investors make logical decisions using the available information. So, thank you for watching.